Market Master. Saurabh Mukherjea, CEO of Institutional Equities at Ambit Capital, joins us now before the big event. Or is it big, Saurabh? That's the question everyone's asking, right? Now that the overhang will be out of the way, do you think that this will just be a non-event for the markets and the market will move up higher post this?
I mean, look, I think in our country we all love specific events. We've got an obsession about elections and how they'll move the market, and we obsess about our own monetary policy, and increasingly we obsess about the Fed's monetary policy. But the way I've read this is, I think this has been telegraphed so far in advance, and the general trend of American monetary policy has been flagged so clearly that this is more a sort of moving feast. This is a moving event, and I don't think one day will radically change what's happening. And what's happening is reasonably clear. Over the last year and a half, we've seen risk assets of all sorts selling off. So whether it's commodities, whether it's emerging market equities, hedge fund inflows, emerging market equities inflows, what's happening is, as American monetary policy gradually normalizes, risk appetite in that country is gradually diminishing, and that's leading to a sell-off in risk asset classes from the entire spectrum, from commodities to equities to junk bonds. I don't think one day will change that. I think that journey will continue through most of 2016, and specifically for India, it will make FIIs more likely than not net sellers of Indian equities, and hence our market will become increasingly dependent on domestic inflows to see some buoyancy. I think FII equities as drivers of the Indian market will become something that we'll gradually forget as the years go by. Domestic equities, domestic inflows will have to be the main source of support for the Indian stock market.
Okay, yeah, there is that, of course. Morning, Saurabh. Good to have you with us. Therefore, how should a stock investor or fund manager approach the markets? Are you saying that what we are seeing now, and we are seeing a bright green paint across the emerging markets, Taiwan, Korea, Hong Kong, Shanghai, Nikkei as well, but of course not EM. All of them are up 2.5% today. There seems to be an indication that the uncertainty will be out of the way. So celebration, at least for the moment. For India itself, do you see this only as a minor relief rally which will get sold into?
I think there's two parts to it. One is the monetary flows story, which I was just describing, where the flow of funds from the US central bank into our country gradually abates, and as the flow of American hot money into all sorts of risk asset classes abate, risk asset classes stage a pullback, as they have done over the last year, and as I think they will over the next 12 months as well. That's the monetary part of the story. The real economy part of the story hinges around China, where the drag in the Chinese economy and the slide in the Chinese currency, which I'm fairly confident will continue. The Chinese will have to continue devaluing the currency in order to regain economic competitiveness. The drag in the Chinese currency will exert meaningful economic pressures across the emerging markets landscape. So let's hope we get a few more days of green here and there to break the monotony. But by and large, the Chinese economy's downward drag will be felt even on our economy. We already have high import duties on steel. I think we're coming up with import duties on tiles. We'll gradually try to build an economy which tries to buffer itself from the downturn in China, but it will be difficult. Overall, for those who are approaching equities, I would say the watchword has to be caution rather than aggression. We are in an economic environment where earnings growth has been very difficult over the last 6 quarters. I think earnings growth will stay difficult. Earnings growth in the Indian market will be hard to come by over the next 6 quarters, and hence you're largely focused on stock picking, and high quality, well-run companies will have to be the focus of stock picking. The overall market is not going to run away anywhere particularly quickly.
Okay, since you have referred to stock picking, let me talk about some of the stocks that are in the news. And as of now, everyone's talking about M&M. In 15 minutes from now, we'll hear from the Supreme Court on the banning of registration of diesel vehicles, and stocks like M&M could get hit really hard. How do you approach a space like this, where one man's pain could be another man's gain? So the demand could shift to petrol cars, thereby perhaps positively impacting names like Maruti.
I won't comment on M&M specifically, as I don't have compliance clearance to do that. However, I think the overall tone and tenor of the discussions I've had with the auto industry over the last 6 months is reasonably clear. I think the auto OEMs were expecting a degree of pressure to move to lower emission engines, and I think that journey towards better quality diesel engines which lower emissions in the auto industry will accelerate on the back of everything that's happening in Delhi. I also think the OMCs will also, the oil marketing companies, the oil refining companies will come under pressure to look at the quality of the diesel they're putting out, and whilst Delhi is front and center because it's the capital city and it's clearly in bad shape from air quality, there are several towns north of the Vindhyas, several towns in North India which have serious air quality problems. So Delhi might be the city we hear about the most, but it's not the only city. There'll be at least 10 other large cities in our country with serious air quality issues. So this matter is not going to be a one-day issue. I think this is a fairly serious issue. It'll stay with us. We'll need to move towards cleaner engines, and we'll need to move towards cleaner fuel. I don't think that those pressures will go away. It obviously will have bearing on the auto industry and also on the oil refiners.
Okay. Saurabh, I want to persist with where you would hide or where you would invest, if you please, over the next 12 months. I think I read one of your earlier reports where you say you see an earnings recovery only in the second half of FY17. So where do you hide till then? Is it going to be drugs and pharmaceuticals? Is it going to be IT?
I'm afraid I don't think there's any sectors where in totality the sector will give you a storm shelter. It is very stock specific. Just to take sort of 3 themes which I think have worked in the last few months and I think will continue to hold up reasonably well. It's reasonably clear that road construction is the one facet of infrastructure where the government has been able to give a meaningful impetus. So government money leading to road EPC seems to work in our country. I think we'll see a lot more of that in the next 12 months. And hence well-run road companies, well-run road EPC companies should be a feature of a discerning investor's portfolio. So Sadbhav Engineering I would classify as the premier road builder. On the EPC side, it's an efficient operation. They also own 15 roads right in the heart of the country, which should do well as and when the economic recovery arrives. So roads is a sector I would look at. The second area where I think there's reasonable grounds for optimism is the rupee is weak. I think it'll get weaker. Interest rates are down, they'll fall a little bit more. More generally, our manufacturing export sector will become more competitive in the coming year. I know we've had a horrible run on manufacturing, 13 consecutive months of shrinkage in manufactured goods exports, a shrinkage in exports in totality. But I do reckon manufactured goods exports will make a comeback next year. And there's a gamut of players to look at. We cover TVS Motors, we cover AI Engineering. But let's take PI Industries, a specialty chemicals manufacturer. 60-70% of revenue is coming from exports to global chemical majors such as Bayer, such as Dow Chemicals. High revenue visibility, well-run company, good balance sheet, good cash flows. Stock has, I think, come off a fair bit in the last 3 months. I would look at a company like PI Industries to play India's manufacturing revival, which I think will come and in effect has to come. We're not going to create jobs any other route really. And the third theme, which we're looking at quite carefully, it is a little fragile at the moment, is this urban consumption recovery. As crop prices, as MSPs stay under pressure, as things like the pay commission click in, as fuel prices throttle off, interest rates fall a little bit, the urban consumer will have a little bit more money in his pocket. And he'll spend a part of that, and hence we're looking for plays around that. We've been buyers of Trent, we've been buyers of Titan for a while. I know Titan's in the news for the wrong reasons today, but I think well-run retailers like Trent and Titan are worth looking at as urban consumption-centric plays. So these are really few pockets I can look at. But in all honesty, if I had to look at India today, I wouldn't be able to give you more than a dozen names where I could tell you confidently these are worth buying, these are sensibly valued, well-run companies. It is a very difficult landscape for stock picking, but stock picking, I believe, is the main way to deal with the current situation.
I didn't notice a single finance stock. Are you moving out of the Axis and ICICIs if you already have them?
So look, we've been sellers of ICICI for the best part of I think 11 months now, And with everything that we are hearing about the Q3, Q4 banking result season, all the discussion around 130 or 150 new NPAs, a concern around banks is heightened. So ICICI, I would say, symptomatic of the challenges facing the Indian banking sector, where barring 2 or 3 banks, everybody else has rotten apples in their balance sheet, and it's just a matter of time when they announce the rotten apples to the rest of the world. My hunch is we're moving to an end game in the banking sector, where the rotten apples will get announced over the next 3 to 5 months, and hence my gun shy attitude with regards to the banking sector.
Okay, well, we'll take that as a positive, that you very soon expect the worst to be out. Saurabh Mukherjea, always a pleasure speaking with you. Thank you very much for dropping by today.
Thanks for that. Thank you.
All right, break now, and another very special conversation is lined up with another Market Master. Ridham Desai of Morgan Stanley will speak about what he expects from the Fed.